Welcome to another episode of Around the Coin podcast. Today's guest is CEO and co-founder of Daffy, Adam Nash. Adam has been in the game a long time. He started, invested, he even teaches a course at Stanford on personal finance for engineers. We talk about Daffy, a donation advisory fund company. They've raised $17 million so far in their last round and 4 before that. We discuss donation and charities, why you should do it, how effective they are, the landscape of them, the demographics. We dove into quite a bit of the details. So hope you enjoy this conversation. If you do, please give us a like, thumbs up, share wherever you listen to this podcast. And without further ado, here is Adam Nash. Well, Adam, I'm excited to be talking with you. Thanks for hopping on the podcast. I really appreciate your time.
Yeah, great to be here.
Why don't we kick it off? We were just talking pre-show conversation, a little bit around your background. You've been in the Valley, you've invested in many companies, been a part of many companies, and a big supporter of crypto. You've been through 4 recession cycles, and calling those out, I think, is interesting to discuss the patterns. And you mentioned the 90s, the dot-com boom, 2008, and today. Why did you say today is similar to the 90s? What is it about today's recessionary cycle that reminds you of the 90s?
Well, I think I appreciate the question, et cetera. There's that old saying that history doesn't repeat, but it sure does rhyme a lot.
Yeah.
So I wouldn't say that the current market is exactly like any of the other downturns, but it's funny when you've had a longer career in tech, you get very used to its cyclical nature, the kind of ups and downs, the booms and busts of the hype cycle, et cetera. It just turned out that when I went to college, right, I matriculated in 1991, the first Gulf War happened. And then we ended up, the Soviet Union basically fell, the Cold War is over. Everyone was looking for a peace dividend. And so the government cut a lot of military spending, which routed through tech. We had a bit of a recession, small recession there. And so I started college at a time when, majoring in computer science or getting a job in software didn't seem so obvious or easy. Hewlett-Packard, which is like the original tech company of Silicon Valley, right? You're talking going back to the 1930s, Palo Alto and Stanford was doing layoffs, big layoffs for the first time. Hewlett-Packard, the HP way, was all about kind of staying by employees the entire time. And so it was really very tumultuous in terms of people's trust and expectation. People had jobs at companies like Hewlett-Packard expecting they could work there their entire careers. And in some ways, I'm seeing some reflections of that now. Right? When you see these layoffs at big tech companies, the big tech companies had never said that the jobs are forever. It's all at-will employment. And I think everyone knew that it was tied to results. These are public companies. But I think a lot of people had gotten a little bit comfortable with the idea that if you had a job at a Google, a Facebook, a Microsoft, that you wouldn't really have to worry about being laid off, right? That their results were strong enough. And so I think this has been a big wake-up call about that cyclical structure, about results. And of course, what happened in the early 90s is that they gave way to the mid and late 90s. And all of a sudden, the internet boom happened. We went from 1991, 92 to layoffs. In 95, Silicon Graphics was talking about how they were going to hire 3,000 to 5,000 engineers in the next 12 months. 3D was hot. And so I'm just used to these kind of ups and down cycles. I think it's very possible that in 2025, we're going to be surprised at the strength of the tech market, given where the psychology was this year.
And do you view while 2008 may have been certainly was driven by a banking crisis, do you view today's downturn as being sparked by a technology recession, maybe an over-investment in crypto, or does that play a significant part into the recession? From my perspective, it seems like the recession is non-linearly distributed across the economy. Like we're at very, very low rates of unemployment, and many of the traditional industries are the same. Hospitality probably is doing pretty well compared to tech. Feels like we're in a pretty significant recession. Do you view the recession we're in now as being focused on technology, or is there another context for how you view our current landscape?
Well, I mean, first of all, listen, not to be pedantic, but I do take a little bit of an academic view on the economic piece. And so it's hard to describe what's going on right now as a recession. Right?
Sure.
But I definitely do think in tech, what you're seeing is you're seeing layoffs, you're seeing basically a constraint. Companies are cutting projects. VCs have pulled back on funding, particularly at the late stage. And so I think it's whatever you want to call this, downturn, et cetera, slowdown, it's definitely very real. But I think there's some patterns that are the same
Mhm. Yeah.
across these different activities. When I look at the pandemic and what's gone on in the last few years, I don't see this as a tech-driven downturn per se. I think this is a natural recoil of just an incredible boom. I mean, just a few years ago, I mean, we were worried about everything falling apart with the pandemic economically. It turns out governments did step in and a lot of money flowed into the system. As intended, people spent that money. And disproportionately, that money went to tech-enabled services, right? Not just straight technology, but, everything. Home delivery, e-commerce, everyone saw this boom. And there was this big discussion of, did we just pull forward 5 years of tech adoption in a year? And certainly for things like collaborative work with all the remote work that was going on, et cetera, we saw these incredible booms. You saw companies and software packages getting huge numbers of users. I mean, I'm an angel investor. I was a seed investor in Figma. I mean, Figma had already existed. I mean, that company's been around for a decade. But I mean, the boom was phenomenal because everyone got religion about the power of remote work and collaborating online. I mean, we all knew it was coming. It just happened a lot faster than we expected, but it wasn't sustainable, right? Like we
Mhm.
weren't all going to stay at home locked up
Yeah.
for
Yeah.
years. And so inevitably you have some amount of recoil. And that's actually very hard for companies to manage. I mean, having been there at both large companies and at startups, it sounds like a good problem to have, like this incredible unsustained surge in demand. I see this in fintech all the time. You see it with deposits, chasing rates, et cetera. But it was very interesting. I think this might be the first downturn where that macro idea, right? The Federal Reserve playing with rates, right? Trying to pull forward some demand from the future to today to kind of smooth out the business cycle. I feel like the technology industry has finally gotten large enough globally that we felt that very much at a macro
Mm.
level. I mean, computers and hardware has always felt the ups and downs of the macro cycle. I think we may not have been as used to it on the software side.
Yeah, that's interesting. So, given the impact that the Federal Reserve and interest rates and liquidity play on venture capital and thereby startup funding, how do you grade the current chair of the board of Federal Reserve? I mean, do you give them, like, on one sense, you could grade them an F because effectively they, at minimum, they misguided their advice on the trajectory of interest rates. And then you could certainly more generously say, hey, like, we're in a pretty decent spot. Like, maybe they did a good job. And so we're at this point now where I'm hearing really bipolar perspectives on, like, the Fed is terrible. They lied and they effectively bankrupt Silicon Valley Bank and caused many other and on the other side, it's like, well, we're not in a bad spot. Maybe they had to do that. Maybe lying or misguiding is actually the best thing to do. But I put that to you. You teach personal finance for engineers at Stanford. I'm curious how you analyze that situation.
Well, I mean, the Federal Reserve and those areas, I've had a chance, fortunately, through my career to interact with some of these people and talk to some folks at the different large agencies across the US government. They pull on some incredible talent and people in terms of economics and
Mm.
finance, et cetera, in order to make the decisions they have to make, et cetera. But the truth is, it's all any topic in economics, you're going to find differing opinions and the models aren't perfect. This isn't, I mean, even our models in physics evolve over time about kind of fundamental aspects of the universe. And economics, we do not have as crisp a model of and
Mhm.
consensus as we do of things like physics. So with all the caveats, I would say, I don't know, I'm actually pretty impressed given all the
Mhm.
political realities of the current environment and the highly unusual environment we are, not just post 2020 election, but the pandemic, global events. It's actually the Ukraine war. Pretty impressive. I actually think that the Fed has been able to manage through that and actually pursue a policy that is fairly by the book. I mean, there's all this debate online about different macroeconomic theories, et cetera, but a lot of different voices about maybe it's different this time, et cetera. But for the most part, we saw a danger, in my view, that I'm just barely old enough to actually remember viscerally when inflation was back and is
Mhm.
back. And almost to the point where it's almost like an old fairy tale, like a video game, like a role playing game.
Mhm.
This idea that some demon from the past that everyone's kind of forgotten. It's fallen, as they say in Lord of the Rings, it's fallen into legend and myth. The idea that actually inflation can happen, but it very much is happening, was happening. And anyone who's studied those topics has to worry that if that runs away, it can be very hard to control and the damage caused. So when I look at the fact that they had to raise rates so quickly, that they were trying to stifle demand, there was a lot of calls to not raise rates as quickly, to sit and
Sure.
wait. If anything, the amazing thing right now is that raising rates that quickly did not cause a recession in the US. And whether that's because of kind of global attributes of what's going around the world, and maybe the US was the best place to be, maybe it's because the way that rates rise and the way that percolates through the economy didn't quite percolate through as strongly as we expected. I mean, people are still fighting about the fact, why didn't we have a recession? Where is the recession? And everyone thought there would be a recession. So, I mean, I'm net positive on what the Federal Reserve has done. Now, that being said, you brought up Silicon Valley Bank, some of these other issues. I do think that when we make these big changes, it's so obvious with 2020 hindsight what's going to happen.
Sure.
And there were people who raised the alarm about regional banks and then the situation that was being set up and what was actually being carried on people's books. But for a lot of different reasons, these things don't get handled. And then everyone says, well, maybe it's okay. And then one day it isn't, right? Everything is very slowly and then all at once. And I'm used to that in technology, but I mean, the finance world, that happens quite a bit.
It's interesting how you sort of cross over these two domains of finance and technology. When you teach your class, if you were to boil down or synthesize the high level ideas that you convey in that class, what's your stance on personal finance for engineering? With a caveat of saying, I think personal finance is just dramatically underappreciated or under taught in schools. Yeah.
Yeah. And that's actually why I teach the class. I teach the class largely because I wish it existed when I was in school. Right. Like, and I open my class with the same topic. It does not matter. Remember, I'm teaching in person. I publish my materials publicly, so you can get them on the web. But in the class, I'm teaching some of the smartest people in the country, in the world, high IQs, some people who are the first in their families to go to college, others that had every advantage coming up. But it doesn't matter if you have a 160 IQ. If you haven't learned the basics of personal finance, of saving, of investing, of credit, purchasing decisions, it's not about intelligence. You actually have to have the material, and schools largely don't teach it. And in the United States, at least, it is considered somehow rude, unpopular to talk about money, to talk about personal finance. And so a lot of students, a lot of people, a lot of adults end up just reflecting lessons they learned from basically their parents, friends of their parents, family members, that sort of thing. And so that's why I teach the class. But the basics I teach in the class are very conservative in some ways, very fundamental. I mean, I take a point of view in the class of explaining the basics of what it means to spend less than you make, what it means to build a budget. I call it a personal income statement, what it takes to calculate your net worth. I call it a personal balance sheet. But I end up ending the class with the basic idea that, number one, make sure understand how you're making money and spend less than you make. Two, make sure you have an emergency fund. Make sure you can cover the unpredictable nature of life financially. You ride too close to that edge, you run real risks that you don't want to run with your life. Third, investing your money prudently, very low cost. I tend to advocate for low cost index funds, a diversified portfolio. I tell most of the students that they are likely to make their money not by being great investors in the market, but by what they do for a living, and then being prudent about it and making sure that they're creating a lot of value and capturing some of that, of course, for themselves. And then I tell them lastly to be smart about taxes, right? That these things do matter. And between those four things, that's what we cover over 10 sessions. But it's been immensely popular at Stanford. I'm now teaching it for my 7th year, and I do tweet about it online, and I put the slides up, and we cover topics as boring as just the basics of interest rates and the history of what different things have returned over the last couple hundred years. And we cover advanced things like options and derivatives and cryptocurrency.
Yeah. It's interesting. I'm curious if people in that class, and generally people who are tuning into this online, are they gravitated towards the investment advice category of saying, hey, Adam, what should I put my money in? Does that tend to be the most attractive of the four pillars there? Like, okay, you could put it in an index fund, but there's this like desire to make money quickly, right? That kind of sparked the whole crypto boom and bust. Is that something you see from that generation, that younger generation?
I've always been surprised in my class that there isn't more of that. It could be because my class does skew towards engineers. who in some ways are actually very conservative. Engineers have this reputation, right? They join startups, they build code, startups go out of business all the time. They're taking all this risk. But the truth is a lot of engineering is a fairly well-paying discipline at this point. A lot of people go into engineering because they want security in their career. They want to know that they're going to have a skill that's valuable, not just for the next couple years, but for their life. And so a lot of the orientation of the class is more about how to be successful, I would say, and what that even means and how to be successful financially. There are people who are very interested in investments, but it covers the entire roadmap. If you come from a family or friends, or you came across content that talks about real estate investing, people want to talk about real estate investing. I actually have an entire session on real estate, both from the point of view is the most important decisions that people tend to make in their financial lives, which is buying versus renting, et cetera, but also as an investor, right? And some of the up-to-date research there. Obviously, I mentioned crypto has been a bit of a topic. There were years where it was stock trading, right? Where it's somewhat unpopular to talk about how hard it is to beat the market over the long term, net of fees, net of taxes. And so, but actually, I would say in general, people who take the class aren't looking to find out how they can become a billionaire.
Yeah.
They're trying to actually learn the basics, right?
Good.
I get more questions about credit scores and how to set up credit and what it means to buy a car. I mean, a lot of the people in my class are immigrants. They're new to the country, right? That system is much more difficult financially to get situated. But most of the questions I get, now the one exception I would say, it is Silicon Valley and it is Stanford. So the number of questions I get about venture capital, about financing startups, about what it takes and by the way, what it takes in terms of lifestyle. How do you have to live while you're building a startup, et cetera? I get a lot of questions about that. That's probably the most unique and atypical thing you'd get from the average American having questions about personal finance versus what you get in Silicon Valley is you can't get away from startups. Startups, first and foremost, it is the sport of Silicon Valley is building companies.
Yeah, totally. And so let's talk about Daffy a bit. So you've raised 17 million from my understanding, and Daffy is a nonprofit, which are two typically non sequiturs. Why did you raise? How did you raise? How is the company structured? And maybe even start by what are you trying to do and why you started it?
There's a lot of questions.
Yeah,
I'm going to try and go through. I'll try and go through them all.
I'm particularly interested in the structure too. Maybe we start there.
Happy to talk about it. Just to back up, Daffy stands for the Donor Advised Fund for You. A donor advised fund is just the account structure in the US and most countries for how to put aside money tax-free for charity. So you have a 401k or an IRA for retirement. You have a 529 for college savings, right? If you're the type of person who gives to charity every year, turns out there's a tax-free account where you can put money aside for charity, get the tax deduction, and have the money invested tax-free and then available whenever you want to give to charity. It's really an amazing financial product. And so a lot of the founding story for Daffy was founded in 2020. My co-founder was one of my favorite engineers to work with at LinkedIn. We'd been talking about doing a company for years. And we just said, listen, we've had all this innovation in fintech around better ways to spend money, better ways to save money, better ways to invest. But giving is almost $500 billion a year in the US. Where are all the great companies, all the great technology to help people give? I mean, this is something fundamentally important to millions and millions of people, right? They make it a part of their lives. And so that's where Daffy was born, right? Like, how do we take this financial product that mostly is only known to millionaires and the wealthy and turn it into an app that everyone can use? I mean, when we launched in the App Store in the end of 2021, we were the first fully functional donor advised fund in the App Store, which is amazing to think about given the fintech boom we've had. So that's the basic idea behind Daffy. In terms of raising money, you mentioned we raised 17 million, 17.1 in our Series A in 2022. We had raised a seed round of about 4.8 million in 2020, basically with just the idea. And we got the team built, we launched the product, and it's been exciting. We've been out there almost for a couple of years, about a year and a half. And it's been phenomenal to see just the reception, et cetera. Now, it turns out every financial product has its own regulatory requirements and back end, right? Bank accounts and debit cards are in one world. Brokerage accounts and investing are another world. We're still trying to figure out what world crypto's in. That'll be always fun. Like everyone, I have my own opinions, but it turns out the big fight's going on there. But it turns out for donor advised funds, almost every donor advised fund in the US, at least national one, is a partnership between a nonprofit and a for-profit. And the reason that exists is because the nonprofit donor advised funds can only be offered by nonprofit institutions. So Daffy.org is a 501c3 nonprofit registered in all 50 states. That's why we can do what we do. But it partnered with a for-profit company. So Fidelity Charitable is partnered with Fidelity, and Schwab Charitable is partnered with Schwab, and Vanguard Charitable with Vanguard. We said, well, what if we partnered a donor advised fund instead of partnering it with a financial institution? What if we partnered it with a venture-backed technology company, right? And so Daffy uses a technology platform to offer its donor advised fund. That donor advised fund technology is built by the venture-backed startup that we raised money for. We call it Aside. It comes from our vision statement. We have a mission. We want to help people be more generous more often. And our vision is a world where everybody regularly puts something aside for those less fortunate than themselves. And so we took that word aside and we called the platform company Aside Inc. And so that's actually the venture-backed company. So Aside actually builds a platform that allows nonprofits to offer donor advised funds. And Daffy is Aside's first customer.
Got it. Okay. And what's the distribution of charitable contributions? Like if you were to look at a landscape of maybe demographics on an income basis, do you find that it's like the typical Pareto distribution where you have 80-20 rule, maybe people over 100,000, 200,000 donate 99% of that $500 billion? Or is there a large long tail? Like, I'm curious to learn a little bit more about the demographics of giving.
Yeah, and it's the short answer to that question is it's both. You actually nailed it, which is that money is highly asymmetric, right? There really are people who have thousands of times, millions of times more money than other people, right? And most people who give don't give huge amounts of money. Percentage-wise, actually, people with less money tend to give more than people with more money. But in terms of absolute dollars, right? Obviously, when a billionaire makes giant donations, contributions, et cetera, that can measure in billions of dollars, it takes an awful lot of $100 checks to match $1 billion. So it just depends whether you're talking about people or dollars. I mean, in fact, one of the reasons we set up Daffy the way we did is right now the entire industry is set up around dollars, right? It's set up around, these are investment companies. They make their money based on a percentage of assets that they hold. And they are very good at acquiring assets. There's over almost $250 billion now in donor advised funds. And some of them are measured in billions of dollars. At Daffy, we have a range of accounts. We have some accounts that are actually already in the 8 figures. But most of our members put a few $100s in their account. If most people give to a few charities every year, maybe they give to their church or synagogue, maybe they give to their kids' school, their alma mater, maybe a national organization or two. But most people donate to 3 to 5 organizations every year. And Daffy for them is a better system to do it. They put aside $50 every month, $100 every month. It's invested tax-free. And then every time they want to donate, they have this app in their pocket to do it. We do see a second group of folks, which tend to have 6-figure incomes or higher, where income in the US has become very volatile, right? People have good years and bad years, right? Ups and downs. This is not just a tech thing, right? You're a real estate agent, right? I've talked to members who are airline pilots, et cetera. There's sometimes you get more work and sometimes you get less work. And the way our tax system works that you pay higher rates in those good years. And they tend to not give you so much credit in the down years, as it turns out. And so actually what you see people do at the high end is when they have good years, that's a good year to put more money aside for charity so that you have it to give in the down years, right? And so we see a lot of this in tech. People donate cash, they donate stock, they donate crypto. And there's huge advantages, of course, when you donate stock and crypto. It turns out you never pay the capital gains when you do that, which is fantastic. But we see both of those types of members at Daffy largely because we've set up our business model to not be about assets, but to be about membership in this nonprofit.
So when I think about charitable donations, I think about a few different motivations. And one motivation certainly is, okay, there's a giant earthquake in some part of the world. I feel bad, and therefore I'm sending them $100 to some charity that is working on helping those people. Then there's the, hey, my grandson is 2 years old and I'm the grandmother and I want to give him money towards his college one day. And those are significantly different motivations. And then there's the person who says, well, I had a high income year. I'm going to put this into a donation fund and I'm going to let that accrue. And then in some way that's going to come back to me more than I gave. So I'm kind of interested in this secondary category. What are the areas where people today are making donations, but they're doing so for their own self-interest? Not to implicitly layer any morality on that. There's nothing bad about using the current tax law structure to benefit yourself. I think that's true. But I want to understand that more. All right. So you mentioned a 529, which I believe is related to the donation of money from people towards a college fund or an education fund. Can you tell me a little bit more about the different regulatory frameworks that exist that people are using today to make these donations for their own self? I don't know if self-interest is the right word. It sounds kind of negative, but
It
self-benefit.
does. But listen, I think that you can always look at it. We set up the tax system for a reason, right? Like
Hmm.
we would have it would just be a simple flat percentage. If we wanted it to be a simple flat percentage, it turns out that we have collectively decided that the government puts the thumb on the scale. We make some things more expensive or less expensive tax wise, right? If you hold a stock for more than a year, the tax rate is lower than if you hold it less than a year.
Wait, can
Why
I
do we do
pause you on
that?
that? Why? Yeah. Tell me why is that? And do you agree with it?
I do agree with it quite a bit because I do think that there are real benefits to incentivizing people to invest for the long term. I think it benefits them because it turns out, given the volatility of the market, long-term investing, everything short-term investments in some ways are gambling, right? Just given the macro effects, et cetera, that's just trading, right? Like the numbers are horrible for retail investors. So I think that from an individual standpoint, it's good for the government to remind people that holding investments for the long term is a better way to go. And also, I think there are benefits in the capital markets to having long-term stable capital. And so having a thumb on the scale of having investments, rewarding people for long-term investments, 1 year, 5 year. I'd probably be in the camp that even longer-term investments should be even more incentivized, but that's a separate story.
When you say, oh, it's kind of like gambling, are you implicitly saying that people don't have enough information and thereby their results from their investments are more random? Like gambling to me, I view as when we say gambling with a negative connotation, we're saying there's no intelligence into my decision. It's just a randomized, I put craps on the table and I shoot the craps and I hope they come back. Whereas investing has this like, I sit back, I run an analysis and I make an intelligent decision as to the deployment of my capital. Do you view that's
Well,
less true on short term?
I think people may say, I think describing it as purely random doesn't quite capture what's going on.
Mm.
Financial markets are incredibly competitive, right? It's not about you not having intelligence or information. Do you have differentiated intelligence for information? I mean, you might have been up all night looking at results for Apple Computer, but you really have differentiated
Yeah,
information
yeah,
about
yeah.
Apple Computer compared to like a million other people. And by the way, there's trillions of dollars at stake. So you're talking about a game where the prize money isn't millions or billions. There's a couple hundred trillion in the world floating around and that you're making these decisions about. So I think people conflate a little bit randomness with unpredictability. And you even mentioned before different distributions. There's a lot of math behind this.
Mhm.
The reality is for most people, I tend to describe it as gambling a little bit more of the unpredictability. Like people talk about poker, there's a randomness to it, but there's also skill to it, right? Most
Mhm.
things in life are a combination of skill and randomness. I think when it comes to investing, the reality is the data is really overwhelming that most professionals who dedicate their lives to making money in the markets have trouble generating alpha reliably. They have trouble generating a better risk reward than just investing in the averages, right? And so, and the reason is because it's not because you can't beat the markets. People beat the markets all the time. It's somewhat unpredictable. It tends not to repeat. And then most importantly, the costs of doing it are so high that it actually eats
Mhm.
up the gains, right? So if you think about
Mhm.
being a professional investor, if you charge 1% to invest someone's money, you have to beat the market by 1% just to get to the starting line, just to get to even. Vanguard's sitting there and happy to invest in the markets for you on average for what, 3 basis points? Right?
Yeah,
That's pretty
yeah.
low cost.
And that's why they say financial advisors are more like therapists than actual hedges on and income.
It would probably be better if more of them had training in therapy.
Yeah.
That would
Yeah,
actually
yeah,
probably
yeah,
help quite a
yeah.
bit. But I actually agree with you. I think a lot of what they do is actually talking to people and why they're particularly
Mhm.
couples, households, right, where you have multiple people. And they add a lot of value that way. In fact, people with financial advisors do tend to outperform people who don't have them but both of them tend to underperform the market averages, net of fees, net of taxes. And so that tends to be why I describe it that way. In general, we like to have agency in our lives. That's why in my class, I tend to talk to people a little bit like, if you're an engineer, the most likely way you're going to make a lot of money and find financial success is in engineering, right? You will either be a great engineer that people pay a lot of money to have on their team. You might even build a new product. You might start a company. If you're a lawyer, you'll be a great lawyer, right? Doctor, be a great doctor. All these paths have paths to financial success. And then, of course, the hardest part, it turns out, is not the investing part. The hardest part is actually just living a lifestyle that's within your means, right? You see this in Hollywood all the time. You see athletes who make millions of dollars a year, tens of millions of dollars a year. And then you read a decade later about how they blew through all the money. You're like, how could that happen? Right? It's unimaginable, so much money. But it turns out that pretty much the market is very good at providing options for you to spend money. Any level of income, any level of wealth, you can spend the money, right? The world's a big place. There's things to buy. There's things to spend. And so everyone struggles with these problems almost at every tier. And so we spend a lot of time on that. When it comes to investing, though, like I said, people want the agency. I'd like to recognize that. People also, especially young people, like to learn, and you learn by doing, right? So the approach I tend to take is not that all your money should be invested in the prudent academic way. The prudent academic way is incredibly boring. I talk about it in my class. Like the entire title of the lecture I give on investing is Good Investing is Boring. But no one wants that message. No one wants to hear that. And people like to learn by doing. So I usually recommend to the students that they carve out some smaller amount of money that they can use to learn and invest in to have agency. But the bulk of their savings, right? 70, 80, 90% of their money that they're saving for retirement, they're saving to buy a house, et cetera, should really be invested in a low-cost, diversified portfolio. Probably the most controversial thing that I talk about at the time is I'm fully willing to accept crypto as one of the asset classes that belongs in a diversified portfolio. But I am very tech forward, and probably there are plenty of academics who would disagree with me on that.
Yeah, well, I think that's why academics tend to be more antiquated and not financial advisors. Do you think that there should be more or less donation funds? Maybe I'm using the wrong word here, but when you think of an advisory fund, you mentioned the 529 and you mentioned another one. I'm presuming that there's a fairly limited, like you count on one hand, the number of programs that are plans that the federal government has carved out. Are there many of them? Are there only a few of them? Should there be more? Should there be less? Like,
there were quite a few. I think last I checked the numbers, over 1,000 in the US. Most people just know the big ones.
Wow.
The Fidelities, the Schwabs, the Vanguards.
Wait. Maybe I misspoke. Oh. So I'm thinking of like when you say the 529 plan, the 529 refers to a federal government.
529 is for college.
529. Yeah. But it's a donation fund that you can put money into.
No, a 529 is a savings, is an investment account that's tax advantaged to help people save for college. It has nothing to do with charitable giving.
Okay.
The donor advised fund is for charitable giving. The donor advised, that's why we call ourselves Daffy. The donor advised fund, or DAF, is basically the account type for charity. And there's about 1,000 organizations in the US that offer them. And last I checked, there's a little over 1 million donor advised fund accounts in the US. So I think to answer your question, there's about 1 million. But there's about 60 million households in the US who give to charity in any given year. I'm a big believer that everyone should have an account set aside for charity. And I believe that both for kind of moral, ethical reasons, but also just pure financial planning. I think that most people most people care about giving, most people do support certain organizations and charities on a regular basis. The problem is because they don't set money aside for it. I mean, we know this from behavioral finance, but when you don't set a goal for any financial priority in your life, when you don't budget for it, when you don't set it up and automate it, right? Like how many people would save for retirement if they didn't have the money coming out of their paycheck every time to go into a 401k? Like we know what happens. If you don't have it automated, people won't do it because there's always something else that you could spend money on. There's always some other stress in your life that needs, there's there's always things. So Our big idea at Daffy is that giving isn't different than another financial goal. And I did a lot of user research. I talked to a lot of people across the country about how they give. And what I learned was that most people were raised to believe that it's not all for them, right? That's too selfish, that some of the money, some of the benefits that they've had, that no matter how they're doing, there are people less fortunate than themselves, and that they should put something aside to help others. I'm not saying everyone believes this, but I'm saying when I talk to people, most of the people I talk to were raised to believe this. And they would talk about a teacher, a parent, a relative, a priest, a rabbi. They always had someone who kind of taught them this lesson. But the problem is people are busy. And so they don't budget for it. They don't get around for it. And so the nonprofit industry has evolved this sales-driven approach where they go out trying to pull money out of people, right? They're doing fundraisers and your friends ask you to give and that sort of thing. And so people tend to give transactionally when asked, which isn't very rewarding, right? It's not intentional. And also it creates a financial stress because most people don't know how much they can afford to give. They never thought about that problem. And so when you use the Daffy app, it's actually the first question I ask you is very simple, which is like, how much do you want to give to charity every year?
And what's the average?
I mean,
what percentage wise, maybe a percentage of income? Like where are people generally landing on that question?
oh, I wish this was the most disappointing part. I mean, as a founder, I know you've been a founder, that sort of thing. Like you always have these theories, you go out and then you actually talk to real people and you're like, well, there goes that theory. That's not going to work. I had hoped that there were like one or two answers to that question. And so I could just build a product that said, oh, do you want to give this way X percent? Do you want to give that? No, you talk to 25 different people, you'll get at least 20 different answers about how much people should give. Some people think of it as whole numbers, right? Oh, you should give at least $500 to charity every year or $1,000. Some people think in percentages. That's very old fashioned, right? And by the way, no one agrees. 1%, 2%, 2.5%, 10%. Highest I got to was 20, but different percentages. And some people do think it's about how well you did this year. This idea that if you have a good year, whether you think that was ordained somehow or through your own efforts, that you have this responsibility in good years to share the wealth.
Yeah.
So I have not found any consistent pattern there at all.
And then there's the extreme end, the like William McCaskill effective altruism. That's like give as much as you possibly can. It seems like if you're going to maximize your impacts in the world, there's two schools of thought. One is you make all the money you possibly can doing investment banking or some super high income work for a good bulk of your life, and then you give that away. Or I think William McCaskill's effective altruism camp is like in reality, people don't do that. And so to set up a consistent donation over time, like Daffy style, okay, every month is coming out of my paycheck. That's more realistic for people, which is kind of an interesting split.
The approach that we're taking in Daffy, it's very interesting you bring this up, is, this is a lot of debate. And by the way, it's not unique to giving. This has a lot of overlap with other financial goals. How do you get people to save more for retirement? How do you get people to save more for education, for college? We talked about tax incentives earlier. That's one approach. You create these accounts, but a lot of the value is actually in the automation and just getting started. So the approach we take at Daffy is we actually, with our users, we try to not push them too much. The one thing we do to nudge people is we have licensed data. So when you use the app, one of the things in the calculator you can see is what the average household in your zip code gives to charity every year. Because we all want to know what everyone else is giving a little bit. Maybe we shouldn't, but we do. And no one talks about it. It's very hard to get this information. And so we try to get people started, though, to just give something. This is a 0 to 1 thing in our book. It's like, you make a commitment to put something aside for charity, right? Don't care how much. It could be $10 a week, could be $25 a month. It could be donating stock or crypto and then when you use our platform, we treat it like every other goal, right? So if you set a goal that you wanted to give $500 to charity this year, we track it just like Apple Health. And guess what? There is confetti and sparkles and rewards when you hit your goals. And then we nudge you to give more the following year to push. So we're more about the journey, about pushing people to get started. But that's because we borrow a lot of our interface from other successful approaches with money in order to get people to hit goals.
There's like two interesting pathways here to me. One is what's the psychology that charities deploy for maximizing donations. And I interviewed one guy from like I think it was BitGive, the name of the company. And they're basically a Chrome extension that makes it very easy to donate in the browser to different charities. And he said to me that the charities will rarely ever disclose the financials because they, to your point, they invest a lot into sales. So they're like, I don't know what percentage, but a big portion of the donations go back into acquisition of more donations. And that people tend to have this almost like moral purity perspective where they say, I want to give to the organization that has like 99% straight to the cause, right? But straight to the cause would mean just Venmo the person you want to give. Like and this is where I get to this question, which is what is the purpose that charities and nonprofits serve that can't be met through the free market? Why do we need them and why do they need to be structured in this particular way in the first place? And maybe the gaps would be, well, we have taxes, the government pools money and redistributes it to those in need. So therefore, they provide kind of a charitable function. Why is there still gaps in society that are unmet that need charity? And maybe speak to some of those. I know there's millions of them that exist, but how many should exist in reality? How many problems are unmet and need that?
I think that's a good question. And so I'll back up a little bit. First of all, I'd say first and foremost, I don't actually think it's an either or, right?
Mhm.
There are amazing social benefits that come from for-profit enterprises. The reason I've dedicated my career to building companies, to help build companies, new technology is I believe that actually the free market, building companies, et cetera, is one of the best ways to build sustainable organizations that can have positive impact, not just for a few years, but for decades and centuries, right? Fundamentally, a for-profit company is a sustainable enterprise, right? It's one that competitively can keep investing
Mhm.
against providing benefits to its customers. And ideally, it captures some of the value it creates for its customers to keep driving the organization, right? So I'm very positive on that. But I think the original theory for nonprofits is still very sound, which is why they tend to be adopted in most developed markets around the world for a large number of reasons. And the idea is there are these collective challenges, there are these social challenges, there are things that have not yet been identified or either are too small,
Mm.
too broad, too understood for the government to immediately jump in.
Right.
And that small, nimble organizations can jump in and actually provide social benefit, right? So, for example, there's a wonderful food bank here in Silicon Valley, right? And they do a lot. I mean, as the cost of living rises, to make sure that they are feeding people who actually have food insecurity and money. Now, we do have benefits from the government to help people. They're not perfect. And there are holes in that system. And sometimes they're complex. And you could say, well, we should just fix the government systems. But in the meantime, there are real people with real problems that would not be addressed without organizations and people saying, what I'm going to spend my life on, or my years, or my time, is actually feeding people,
Mm.
helping people, going after this cause. And so once again, we've agreed that societally that is a social benefit. And so for a number of historical reasons, we are okay with money donated to those things not being taxed. And we could debate scales of that or ranges and that sort
Mhm.
of thing. But I actually fundamentally believe that system is that logic is sound,
Yeah.
right? Governments will never move fast enough, never be brought up. They're too big, dispersed. They'll never move quickly enough to address all these needs. And there's this fact. I mean, I don't know. I love these old technology debates and business leaders, et cetera. But this was the old debate between Bill Gates and Warren Buffett and some others. This idea of like, as a capitalist, Warren Buffett believed fundamentally, my job, I'm great at compounding capital. And this is
Mhm.
why I studied Warren Buffett my whole life. He believes he has a gift for some reason and figuring out how to compound capital, that his value will be creating that capital. And then, yes, that will go to a bunch of good causes and help a bunch of people because he doesn't believe in leaving all that money to his heirs, most of that money. And what flipped him around is the same thing that flipped Bill Gates around at one point, which was, yeah, but there's a real cost today, right? That equation, that morality of that life in the future versus that life today, that's a very difficult philosophical problem, right? You could cure malaria now versus 50 years from now, right? And what is the value of that? What does that mean? And is a person in the future the same as a person today to a person today, like us, more ethically. I mean, people debate this. I think
Mm.
there are good debates, but I probably side in the camp that says that there is real value today. And I think nonprofits, a lot of nonprofit organizations. I mean, there's almost 2 million in the US, well over 1.5 million. I think a lot of those nonprofits start because good people see a local need
Mm.
and they say, hey, we should get some money and resources together to help solve this today.
Yeah, it's a good point. So your 2 points are basically that there's inadequacies by the government and that there's R&D necessary that the government can't deploy. So those both make sense to me. And then I also think that the same psychology that applies to the bloat and the bureaucracy that occurs in government and in companies probably is happening behind the scenes in nonprofit. And that one of the one of the areas that I'm most critical of nonprofits for is in hospitals and healthcare. So many hospitals in the US are nonprofit, but in practice, that doesn't mean they're operating with any higher virtue or morality or doing anything better. It just means that they don't pay property tax by being nonprofit. And so you have like Cedars-Sinai located in Beverly Hills who avoid something like, and they were an investor in my past company. So I love those guys, but they do have a structure that they avoid tens of millions of dollars in taxes because they're a nonprofit. And in return, they have to do stuff. You don't get that designation for free. They have to go and give services to people in low income areas. And so they have that arm, but they're not doing it out of the goodness of their heart. They're doing it because there's a financial incentive. It's better for them as a business. And those are the areas where I think, okay, there's millions or hundreds of thousands of nonprofits. How many should we have? Should we have like 1,000 and the rest are bloat? Like, is there a lot of bureaucratic bloat in nonprofit? And what's the path to a better world in the giving space? And I don't
Yeah, I think
say all of that to criticize, but I'm looking
no, no,
at it.
no. And I think that it's an interesting topic. Like I said, at Daffy, we've taken more of the point of view of how do we free up more money for
Mm,
causes that people care about, right? So the behavioral research says that when people set a goal for their giving, when they put money aside, they end up giving 32% more
wow.
than when they don't. And so if you think about it, individuals in the US give about, of that $500 billion, over 300 billion a year is from individuals. And so for us, like what gets us up in the morning is this idea that if everyone had an account like this, a product like Daffy, we might free up another 100 billion a year
Hmm.
for organizations and causes that matter. Now, on the other side, you're bringing up, I think, fundamentally some regulatory questions and kind of policy questions, which is like, yeah, what these organizations do offer services and they do make money. And what is the line? I mean, we hear this debate about large universities with huge endowments. What is the responsibility
Right.
for having that much money tax-free? You have churches and religious organizations that have accrued huge amounts of money
Yeah.
and real estate. And we know about abuses in different areas too, right? Organizations. I mean, the set of scandals, if you look at regulators in different states, you can almost see that
Mm,
they've dealt with nonprofits and scandals before. And I tend to be very pro-regulatory in financial services in
mhm.
general, because I do think that it's hard to know what you need to know. You need to have some trust in the system, some faith that people are doing the right thing with money. So I think these are all good questions. And I don't think that there are simple answers to them, but I do think in general, you'll see with all the patterns that a lot of the money freed up wouldn't have gotten there otherwise, right? There
Mm.
actually are limits to taxation and what people will tolerate, et cetera. By the way, we saw this in e-commerce, the big debate when I was at eBay back in the day, right? It was one of my first, the Web 1.0 company. I kind of cut my teeth as product in the web. This debate about shipping, right? Like people hate paying for shipping. They want free shipping. But if you look at the total ticket size at the end, if you charge shipping separately, people end up paying more, right? This is why tipping exists. Everyone who wants to get rid of tipping, and there's a lot of people who want to get rid of tipping or are frustrated about tipping, et cetera. The reason tipping is so sticky is into the end of the day, when people mentally account for things separately, this is the money for the food, this is the money for the service, they end up paying more than if it was just all in one bill.
Why is
Like they
that?
want the bundle to be cheaper. So
What's happening
I
there?
think that if you're looking at the top level, the truth is the system we have right now, like you talk about Cedars-Sinai, et cetera, when you see those large donations for a new hospital wing, and maybe the guy's doing it for a little social credit,
Mhm.
burnish his image in the community. Maybe he's doing it because actually he had a personal issue, a child, a family member who had that illness. And he was frustrated that the government decided to fund overfund one illness that
Right.
was very popular in pop
Right.
culture that Hollywood celebrities got behind versus funding one that actually kills a huge number of people and said, you know
Right.
what? I'm going to take the value that I've created in my life, that wealth that I created. I want to put it towards that and helping families and people who have that illness like me.
Mhm.
I'm pretty sure if you looked at it at a top-down level, that if we got rid of this system, fewer dollars would be flowing to these causes. Fewer
Yeah.
dollars would be flowing to help people, despite the fact that any system that has a lot of money move around will have some level of abuse, some level of inefficiency. This is why we try to do things with regulations. This is why we try to set rules in the system. But, I tend to look at this system more. I mean, the nice thing about being at Daffy, making this my mission, the platform I'm going after, is I like the simplicity of it. When I said at the beginning, our mission was to help people be more generous more often, I said the root here, the root problem in my view, is that life is hard. We're busy. We have work, we have family, we have social life, we have all these concerns, etc. And I think it's a lot to ask for people to also add on to that every day, making a conscious, intentional thought about, like, maybe not all the money's for them. Maybe there are some
Right.
people that they could help with those resources. And so I like building systems that make it easier for people.
So my point was that I love your trajectory. I love the mission, increase, maximize, or encourage more donation from the public market. 300 billion of the half a trillion is individual donations. I think there's, from my perspective as a giver, just an individual in the crowd, is that there seems to be a lack of, I don't know if it's transparency or insight as to what effect are each of these million different organizations have. And because I don't quite know, I don't give, or I don't give as much as I would. So I would give more if I could see what's the financial P&L of this company look like, and what's their viewpoint on why 40% goes to marketing. Maybe that is fine. And maybe there's this like large scale misconception among nonprofits that we can't disclose financials, because if we do, then people won't give. And I question that. I think that the nonprofit industry can go through a huge revolution and massively increase donations if, like, systemically across the board, there was just par for the course to disclose finances and be more transparent and have it be publicly known that a large portion of our donations goes into sales and marketing. And that's how it should be. It shouldn't be 99% straight to the person and whatever it is. So that was my only point. And that's what I, as an individual donator, would love to see.
And I think the issue you're expressing is very normal, and we hear it a lot,
Mm-hmm.
right? Like, this is, I don't know if this is the number one issue that people have, but this question of who can I trust with my donation?
Right.
Who do I give my money to is actually a very big one. And we've invested a lot at Daffy. We have a number of people who worked on some of the best search engines in the world, right? We have people who worked at, like I said, eBay, LinkedIn, Twitter, Slack, all these companies. Part of the Daffy idea was we could apply modern technology. I mean, we are even using AI now and GPT to kind of go through regulatory filings. Nonprofits
Cool.
do file 990s with the IRS, et cetera. How many people out there feel comfortable downloading a 990 and going through tax forms to figure out what's going on? Very few. But maybe GPT can synthesize that into human English and make that easier for people to understand. So we think that's an important problem. But a lot of the Daffy idea is built around having two difficult problems, not just one. One being, how much can I afford to give? And two, who do I give it to?
Mm-hmm.
And so part of that whole idea of a donor advised fund, the reason you heard me say that this is a great product for everyone who gives, not just for the wealthy, is because separating those two problems. The first is fundamentally a budgeting problem. You asked earlier, and it's okay with me. Anything that's not zero, I'm okay with. You want to give $100 a year? Great. You want to give 1% of your income a year? Fantastic. 10%? Even better. Put that in an account aside so that you have the time, right? You have the resources to make good decisions about who you give the money to. But I do think that technology can help a lot with that problem. Another thing that we've seen at Daffy is that people learn a lot about what organizations they can trust from their friends and colleagues when you let them. The problem is we don't have a place to talk about this stuff. I mean, I'm the original, I ran product at LinkedIn for a number of years before the IPO. I've been on eBay, like e-commerce marketplaces, et cetera. Trust is a hard problem. Some of what we learn though is from other people. And you just don't get a lot of that discussion on Facebook, Instagram, Twitter, LinkedIn, et cetera. It can't compete. It can't compete with dating and news and money and business and all the things that people talk about. And so one of the ideas behind Daffy is giving people a space where this part of their lives can be the focus, right? This is and Daffy, when people make donations on Daffy, we ask them to leave a public note. They don't always, but most of the time they do. And these notes are phenomenal, right? You have someone who says, listen, I'm giving this, or this congregation was there for me when my father passed away, and I support them every year on the anniversary of his death. I mean, these are very human things that come out. And so I do think that there's a lot more we could do. I will tell you though, that nonprofits really struggle, right? They don't have the money and the budgets. They want to spend money feeding people. They want to spend money helping people. They don't spend money on software technology and IT. I mean, maybe the largest 100 do, right? Our second donation at Daffy was from someone, Orthodox Jewish man, who wanted to give a Bitcoin to his congregation. But of course, that congregation doesn't take Bitcoin. Most nonprofits aren't set up to take crypto or stock or all these assets. But we already built that technology.
Yeah.
You want to donate a Bitcoin? He said he read our basic release when we launched and said, oh, I get it. I give you the Bitcoin and you'll get the cash to the organization. You'll get the cash to the synagogue. And so one of the reasons we like this idea of building out a platform for giving is, if you think about it, it probably doesn't make sense that 1.5 to 2 million tiny organizations would somehow build the IT or the capability. Most of these organizations don't even have websites.
Totally.
Right? They don't have apps and that stuff. The idea that we could provide a channel, kind of the way LinkedIn back in the day, when I was working on LinkedIn, LinkedIn provided a way for companies to put their brand and what they worked on forward to the talent out there, not just people looking for a job, but to everyone. I'm hoping that Daffy becomes a place where nonprofits can put out that great information, can reach the type of people who give, and we'll get more information to people because we'll create a real marketplace between nonprofits and donors, as you described.
Wow, that last word. I think marketplace is the biggest potential impact, because if you can have transparency and there can be real competition, because there's certainly the heartfelt donation, right? I struggle with this and therefore I'm going to give to this thing. That is great and people should do that. But then there's also, okay, I have $1,000 to give and I just want to give to the maximally effective donation. Like, what causes the greatest good in the world, reduces unnecessary suffering the most? I think Bill Gates' answer to this is like malaria. It's like, by and large, just like that's the answer. And it seems to be that's still the domain, the problem that causes the most unnecessary suffering and death. Maybe that changes, or maybe it has changed. I'm not sure. But that would be your point there on Daffy creating the marketplace of effective altruism. It's like, where does money, if I'm not emotionally attached to the donation location, then where do I point it? And that, I mean, the ability to point donation dollars via a marketplace would be, and that's a really powerful tool.
I think it is. Although the reason I do like the idea of a marketplace is I do think there's a lot of value in people's individual experiences, in what drives them, what motivates them, et cetera. And so this is a little bit like, sometimes I get a little worried. I surround myself, a lot of people are into health and fitness, and you spend enough time with those people, they're like, no, this is exactly what you need. Right. Actually, your body needs this, you need this, et cetera. And then you're like, wait, are we getting to the George Jetson kind of era where like you're just taking pills every morning? Like, I actually like food. I actually like doing that.
Mm-hmm.
I like all these different things. So I think there's a lot of value beyond pure efficiency. I think our lives do touch things, right? Like, if you've touched a particular illness in your family, it's viscerally different, that impact, than someone who's talking about it purely in theoretical nature and numbers of how many people have this and how do you quantify pain or the value in someone's life. You said unnecessary suffering. They're not to quantify suffering really well, or at least not perfectly. And so what I like about, and I think there's power, you mentioned free markets in the beginning. I think there's a lot of power in people basically voting with their time and their dollars towards causes and things that have touched them, that they believe in. And I think we can learn a lot about it in the aggregate. But you can't do that unless you actually have a platform and a system where that information gets out there, where people really can learn and vote. We're trying to build Daffy not to be just about dollars. I mean, a lot of the way people get involved with organizations, they volunteer, they're on boards, they do events, they do fundraisers, right? There's all these things that they can do in the community. And we're trying to make Daffy about all those different things, not just giving dollars. But I agree with you. I think that if we could find a way to open up channels where nonprofits can put out the good work they're doing, I think that's more likely to trigger people in terms of what speaks to them, where they want to see their time and money go to. And I think we'll learn a lot. I think it'll free up more giving. And I think it'll also help drive the industry to be more and more effective in terms of what it's going after.
Yeah. Because I think it is two sides of the coin. It's like efficiency and effectiveness. You get more effectiveness when you're more efficient, and the volume of donations goes up by making it more transparent, allowing people to see where the efficiency or inefficiency is, like making sure that that's effective. Adam, I won't chew up too much of your time. I have one last question for you, which is just about you.
Sure.
I want to know, are you writing online? Are you on Medium, Twitter? Are you anywhere personally that you want to throw out there? We'll have all the links for Daffy, the website and Twitter and everything else. I should call it X. They rebranded. But go ahead. Tell me where you are, maybe point people in that direction.
Right. So I think, listen, I've been on social media a long time, been working in the industry a long time. So you certainly can find me on LinkedIn, Twitter, or X as the rebranding goes through, for sure. But I actually have been writing for a long time on my blog. If you have listeners who are interested in either angel investing or startups or product, it's probably what I'm best known for, or fintech. It's just adamnash.blog is there. But most of my writing these days has been on Daffy, right? Daffy.org has a resource list. So if you have questions about giving, about taxes, about the benefits of donating crypto or donating stock, I mean, obviously in the product, we make this very easy to do, but a lot of people have questions about how to think about those problems. I write a lot, and I have written a lot in the last couple of years on Daffy. So feel free to check me out on any of those channels.
Cool. Yeah. And also you have the personal financial course online at Stanford for engineers, which I'll definitely check out too. That's awesome you do that.
Yeah, that's on a separate site. But if you go to, the course number is 7. So of course I branded it 007 because, I mean, why wouldn't you?
Why not?
But if you go to cs007.blog, you'll find the course material for personal finance for engineers for the last 6 years.
Awesome. I'll check that out. Adam, thanks so much for your time and congrats on all the progress. Wish you nothing but the best.
No, fantastic, Mike. It was great to be here.
Cheers.